Welcome back. Let's get straight into the market news now. And Asian markets were mixed on Wednesday this morning following a negative lead from Wall Street as investors grew nervous about the chances of success in that China-US trade talk. And that's particularly ahead of a crunch meeting that happens next week. Now, the mood does remain cautious with the rally that has characterized the start of the year stuttering, owing a lot of that to a slowing Chinese economy, what seems to be a softer global outlook, and even other issues, including Brexit itself and the United States government shutdown, of course, which is on day 33, which shows, of course, no sign of ending anytime soon. It was an up and down day of trading across Asia, with Tokyo's Nikkei also slipping around 0.1%. That's sitting at just above 20,000 points. The Hang Seng out in Hong Kong was mostly unmoved at 27,000 points. The Shanghai Composite also managed a marginal gain at close of trade, ending the day at around 2,581 points. Let's head on over to the United States now, where stocks managed to end lower on Tuesday, snapping a 4-session rally as a gloomy global economic growth outlook, trade concerns, and disappointing company forecasts dampened sentiment. So what goes up must come down. The Dow Jones Industrial dipping 1.2% to 24,407 points. The S&P 500 in the red by a margin of 1.4% to 2,633. The Nasdaq Composite took a dive, falling almost 2%, just above 7,000 points. The markets have been stuttering along and unable to continue to match the progress that they'd like as of late. It has stuttered along for the preceding parts of this year, a whole lot of them not managing to get the gains they would like. The CAC around 0.25% firmer, the FTSE 100 as well, however, losing about 1% today. The DAX as well, easing around 0.1%, so slightly cheaper on that front. The all-share index today slipping around 0.5%, with industrials over 1% weaker. Financials as well, similar mark, 0.25% down as well today. While you take if you were to take a look at the resource index, around 0.1% higher today, with the gold index as well climbing 0.8 percentage points. Let's unpack all of this data and all of these numbers, including how the commodities are faring, even the rand as well. We've been joined in studio by Makwe Masilela from Makwe Fund Managers, of course, as we unpack all of this data. Makwe, thank you so much for your time.
Pleasure.
You may have seen a little bit earlier on as well, we're talking about the World Economic Forum. Just quickly, your sentiments. Are you getting a message that it actually means something to be out there now? You've got 4 world leaders who have decided not to join because they've got their own problems themselves at home. Is it still the elite class that everyone has looked at for so many years?
I think it's starting to lose the meaning because the reason that they gave their own political or economic situations back home, we all have those issues. So we could have also stayed back home that we've got issues to sort out here, you know. But as you are saying, it's not just only 4 leaders, it's 4 major important leaders, you know. You're talking the UK, you're talking the likes of the US, China as well. And I don't know, maybe China just decided at the 11th hour because Donald was not coming. I mean, for them to say they've got economic issues to sort out, I don't see, you know, that as a main reason. France as well. But yes, one starts to ask that every year, when people go out there, do they come up with something, or it's just a question of sensing what other people are thinking? But ever since then, we've not seen anything has to be implemented back home here.
Yeah, if you take a look, I mean, even you'd see that the Africa World Economic Forum has also even been cancelled, really, over the past 2 years. It hasn't happened. So clearly the message there is, let's do it on our own, Africa. We don't necessarily need the WEF Forum to do it.
By all means, I mean, think about it. We all say small companies or small medium enterprises are the ones which are driving the economies, are the ones which are creating jobs. But do we see them attending? We don't.
Yeah. A situation in itself where this might become redundant every year in order to go to a cold place out in Switzerland, which seemingly, as you can tell from my colleague in Zinga, doesn't necessarily make the greatest sense. 0.5% down for the all share today. Across the market, it just seems to be some profit taking going to the fore. Nothing really to be worried about on this front. No real equity news as well coming to the fore here.
Exactly, and I think people have got their eyes when it comes to Davos. People are looking at Davos, and back home here, we've got our own festival of commissions that as well is taking the market attention, whether we like it or not. But I think the one thing that has been driving the market today, the fact that we know that the planning meeting that was supposed to happen, apparently it has been cancelled, even though the advisors are saying no. But that's a very crucial meeting because it's preparing for the vice presidents to meet end of this month.
Yeah.
So now the issues now, it confirms that as people have doubted that, you know, the two parties are still far apart. So that itself, I think, is the one which is just made that risk sentiments. People have to say, let's wait and see. But at the same time, China as well managed to help by stating that, hey, come this year, we're going to put more money as government. We're going to increase our spending to make sure that we drive our economy. We saw the numbers on Monday. They were not impressive at all. We've seen the report coming from IMF as well, downgrading the global economic growth. So for China to say we need to spend, we have to start spending more as a government to make sure that we grow our economy. But stimulus is only okay for a certain period of time. You cannot continue to stimulate the economy forever and ever. Amen.
Yeah, after that, it kind of has to run for itself, right?
Exactly.
6.6% for China, that growth number that we saw coming out earlier this week. Are we panicking?
As a number coming out of China, yes, but I think we've seen the number, you know, coming, that, you know, China's not going to do well. If you check their quarterly reports, you check their industrial output, their retail sales that they've been releasing, they were not shooting, they were not very exciting. So one could have a sense that China is kind of slowing down, you know, and I think that's what's happening with them, is kind of slowing down. But one has to also to factor in that trade issue, we might undermine it, but just check the exports that Japan just released. Japan's exports for December fell, you know, by almost 3.9%. And mainly things that they have to export to the likes of China, things that have to the likes of Taiwan. So we might be looking at the two, but other countries as well around the area gets to be affected. So it's not a good number going forward, but hopefully they will put in something. And I think last year as well, they did manage to put in some stimulus by cutting some taxes here and there. So hopefully they will get things right going forward.
Here's a number that will get our previous guest here a little bit happy. Lesetja Kganyago, the governor of the Reserve Bank, who's out in Davos, of course. 4.5% for inflation in December, as expected. Is it something, however, that we should be writing home about and being exceedingly happy, considering the fact that it was expected for December?
I think we should, and I think maybe the governor had a sneak, you know, when they were making that decision last week. I mean, but you see, it's right at the middle, and remember the Reserve Bank, they're looking at inflation expectations, inflation 6 months from today, and they're happy to see it around the 4.5% or so. And now one starts to argue and say, we told you that the rate that you hike that you had in November was not supposed to happen. Here it is, all the factors that you're worried about, within a month, everything changed. The rent strengthened, oil prices, petrol prices.
Were they too cautious? Were they too cautious?
I think they were, and I think it was more of a split, if you remember. It was 3-3, then he was the one with a deciding vote. But it shows you that they didn't have it right, and they did indicate going forward that, listen, it's all going to be data dependent. But yes, we're all happy, not only him. And going forward, inflation might continue to decrease depending what's going to happen with the rent. So
and he loses credibility if he drops it now, doesn't he?
You know, by all means, but I think he can justify it, you know, that, guys, I'm human, we misjudged, we had our model gave us something. Variables have changed. Whoever thought that the rent is now going to be trading at 13.90, no one thought of that going forward. Whoever thought that oil prices will be trading at $62 a barrel, we never thought about that. And I think we have to be human and say, listen, whatever you anticipated, your assumptions have changed. And by all means, you are allowed to also change your forecast going forward.
Very quickly, I have run out of time though. 13.90 odd against the US dollar for that rand mark. Do you expect more rand strength, or do you see it being more the fact that the US dollar might be weaker considering those China trade talks?
The US dollar, inflation has done its thing by making us, the low inflation has helped the rand, that's it. But now it's going to rely on what's going to happen with the US dollar going forward.
Makwe, appreciate your time. Always great having you in studio as well. Makwe Masalela is from Makwe Fund Managers there, giving us the latest on that market look and his thoughts on exactly how proceedings may fare. We'll continue to unpack the world of markets, business, news and economics right after this short break. You're tuned to Market Sense here on Point.